In this presentation, I'm going to cover the difference in treatment of component depreciation under GAAP and the international standard. Okay, under GAAP, although it is permitted to break down a depreciable asset into components if they have various lives to depreciate, this is not commonly used. Normally what will happen, for example, if we bought a building, the whole building would be depreciated at the same rate, even though we know that the roofing may last differently than maybe the air conditioning or the floor covering. Instead, we just throw it all together and come up with one rate. Under the international standard, it is required that a depreciable asset comprised of components with different useful lives and or salvage values be depreciated on a component basis. So it is a requirement under the international standard. So if we're going from GAAP to the international standard, we have to take this into account, or the other way. So now let's take a look at an example. In this example, Mike bought a building on January 1st, 2017 at a cost, that's Mike's company, at a cost of 10,000 rupees. So in this case, we're going to be going from the international standard to GAAP. The building has an estimated life of 40 years and no salvage value. The company decided that the building is composed of three significant components. We have the building, and we're assigning a value of 8 million rupees to that. It has a 40-year life, and so therefore the annual depreciation on that would be 200,000. It has a roof with a cost of 1.5 million rupees with a useful life of 15 years, so we get 100,000 for that. And then we have a cooling system with a value of 500,000, 10-year life, and therefore 50,000 annual depreciation. So when we add that up for component depreciation, we would get an annual depreciation of 350,000 rupees. Now, Mike's company must convert from the international standard to GAAP for consolidated financials. What journal entries would under the international standard and GAAP be required for 2017 and 2018? And also, what would the conversion worksheet look like for those 2 years? So again, we're going from the international standard, which uses component depreciation, to GAAP, which doesn't. All right, for 2017 entries, so when we look at the differences between GAAP and the international standard, for the international standard, under component depreciation, we would record 350,000 rupees, as shown on the previous page. Under GAAP, depreciation expense would be 10,000 rupees divided by 40,000, giving us an annual depreciation in total of 250,000. Now we end up with a difference of depreciation each year of 100,000 between the international standard and GAAP. So here are the journal entries. For 2017, under the international standard, recording of the purchase of the building and the cash would be the same under GAAP and the international standard. However, our depreciation expense is different. So for the international standard, it's 350,000 based on the previous slide. And under GAAP, it is going to be 250,000, which is the 10 million rupees divided by 40. In 2018, we have the same journal entries, and again, we've got another $100,000 difference. So now our accumulated depreciation is different by 200,000. So now let's take a look at our work papers. So in 2017, on the conversion work papers, converting from the international standard to GAAP, we would have to remove excess depreciation of 100,000 rupees. So what we would do is decrease accumulated depreciation and decrease depreciation expense. In 2018, now we have an accumulated amount of 200,000. So we would reduce accumulated depreciation by 200,000. However, what we're going to do is we're going to credit retained earnings for the 100,000 from the prior year, and we're also going to take out of the current year depreciation expense 100,000 rupees. Now, in summary, what does that look like? So on the income statement, we have a difference each year between international standard and GAAP of 100,000, which means that for GAAP, what we'd have to do is reduce our depreciation expense by 100,000 each year. On the balance sheet, our net book value is going to be different between the international standard and GAAP. As our depreciation accumulates, you can see that by 2018, we have a difference of our 200,000. And that concludes what happens when we use component depreciation versus regular depreciation, and the difference between the international standard and GAAP.